So let's get started talking about retracements and reversals. Now, in tonight's class, I'm going to use the term security. I'm also going to say stocks or bonds or commodities or futures or indices or CFDs or cryptocurrencies. I'm not at that point talking about a very specific instrument. I'm talking about the general field or all the assets you can trade with CFDs or all assets that are traded in the financial markets in the open marketplace. Because tonight what we're talking about will fit all of the markets. And I'm also going to intermix the terms investing and trading. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. But in either case, the basic concepts and techniques presented in this class are equally adept. And I know the difference between investing and trading, and you know the difference between investing and trading. But it just gets very boring saying trading, 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 so I intermix the terms. Now, retracements and reversals fall in the field of technical analysis, because anything we do on a chart is part of technical analysis. And sorry about that. It can be even more defined as chart analysis. Now, everybody's asking, should I buy today? What will the prices be tomorrow or next week or next year or even an hour from now? Wouldn't investing be easy if we knew all these questions? There's seemingly answers to all these questions. But I don't have a crystal ball or a Ouija board. So if you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this class with the hopes that technical analysis will improve your investing and trading, I have good news for you. It will. Now, it's very, very important that every trader uses charts, because you can't trade successfully just by listening to news and jumping into a price. You have to be able to look at a chart, price chart, and understand what the price of an asset's trying to tell you. So the ability to spot the difference between a retracement and a potential reversal is a great tool to add to your trading arsenal. Now, many inexperienced traders, along with some of the most experienced traders, are still unable to detect the difference between an asset's retracement and a potential reversal. Now, most people, or most novices or people that aren't trading, think that price moves this way. You know, they also know it can move that way, but they think it moves in a straight line. But price doesn't. Price moves in peaks and troughs, peaks and troughs, peaks and troughs, peaks and troughs, or tops and bottoms. You can call them, whatever you want to name them. Okay, a lot of us call them waves or cycles. But price doesn't move in a straight direction upward. And a trend that moves straight like that is not a healthy trend. That means there's something in the market, some volatility that caused it to go up or down, and it's going to recover anyway. Okay, as we can see here on this chart, price moves, let me get my markers off of here. Price moves in a push and an ease, push and ease, push and ease. Now, these are known as retracements, these eases. And retracements are a healthy sign that a trend is doing well. Okay. It'll also give you entry points to enter into a marketplace. So let's start off with some definitions. What is a retracement and what is a reversal? Retracements are momentary reversals that often occur during a longer trend. Unlike reversals, retracements show a continuation of an opposing trend within a targeted asset's price action. In other words, it's the push and the ease, the push and the ease. So as you can see in this picture over on the right, there are a couple retracements that take place and occur throughout a prolonged period of time. Now, reversals are temporary changes in the asset's trend that occur over a short period of time. Oftentimes, these reversals can last minutes, hours, or days. It just depends on what time frame you are utilizing on your charting solution. Reversals are oftentimes drastic and do not represent a long continuation of the opposing trend during the asset's price action, like seen with a retracement. Now, that's a lot of words, but I'm going to show it to you, believe me. Okay. But there is a big difference between a retracement and reversal, but it's hard to spot them or determine them right up front. But some of the ways that we can quickly reinforce our view is if we see profit taking by retail traders, small blocks of trades with volume, okay, we'll see that that's normally a retracement. Most of the time, if we see big blocks of trades in the volume, it's institutional selling, and most likely they're jumping out of the market because the market's about to reverse. I'm sorry. I'm coming down with a cold here. Okay. Now, also, there are some chart patterns, like in candlestick patterns, that will help us see whether we're in a retracement or a reversal. Usually a retracement occurs when there's been no fundamental changes in the market, no news, no headlines, no economic events. Where a reversal usually occurs when there's been a change in the fundamentals or people are speculating about something happening. Okay. Then candlesticks will help us because when we get things like dojis that show market indecision, okay, or long tops and long bottoms, like spinning tops, these are usually retracements. If it's going to be a reversal, we'll see things like bullish and bearish engulfing, or three black crows or three white soldiers, or other candlestick patterns that are known as reversal signals. So what? So I'm going to share with you a quick little presentation which I put together that's going to show you what the difference is between a retracement and a reversal, and how we can use these. Now, also, this is explained in great detail in your handout. So let me take you over to a live chart and show you this in the live markets so that you can actually see how we apply these. So I'm going to pop up on your screen. There we go. This is a live chart of the Euro US dollar. Now, if you notice, price is moving in a general uptrend. We can just see that with our eye. We don't need to put a trend line on here right now. We can also see price pushes and eases, push and ease, push and ease, push and ease. This is how a healthy trend will work. Now, sometimes you find them very well defined. You see them absolutely beautiful. Now, this one's a little bit dodgy because we went into a whole bunch of stuff here in congestion, but this is in a 1 hour chart. If we put this out in a half-hour chart, you would see this range and probably see it more precise, because even here in this little wave, we have a push and ease, a push and ease, because this is how price moves. Now, why? Well, let's talk about one of the most easy to understand concepts. Here we saw price coming off of a downtrend. We probably had sellers jumping out of the market. We had buyers jumping into the market to get in here. As the buyers try to jump in the market because the price got fairly low, they're pushing the price up and causing the rally. At some point, the buyers who were buying at this level as the price was way off of its top said, okay, that price is getting too high. Most of the time, you will find that that hit some type of an important level, whether it was a Fibonacci level from the previous downtrend, whether it was a retracement level, whether it was a recent high low of a candle, or a long-term a support and resistance level. But at some point, the buyers are in the market, the buyers are buying and buying, and they say, again, here at this point, the price has gotten too high. Or maybe in this case, there was an economic event and they sat on the sidelines for that economic event. Whatever it is, when the price fell back again, those buyers who moved to the sidelines re-entered the market. They continued pushing that market up here to here to here to here. And then again, those buyers who entered the market at this level, they got the points they wanted. Okay. For whatever reason, they said, okay, and they started selling. A lot of people out of the market, if they can make 50 points, 20 points, 30 points, that's when they're out of the market. They've set up their orders ahead of time. They're not in the market to let it run for a long time. They're in the market to make a couple points, especially day traders, to get a couple points to get out of the market. Well, these are where those pre-existing sell-offs were set. Or even the guys who bought down here and didn't sell out in this rally, came up here and said, it's hit an important resistance level. And look, it's not really doing anything. The closes are staying all on this level, and they've sold out of the market. In the meantime, the potential buyers who were still interested in buying because they know the price is going to go up have said the price is a wee little bit too high for us to buy. We're going to wait till it eases down. So price falls, and these buyers who had sidelined re-enter the market, pushing it back up. And this is a standard retracement. Up and down. And when you have these, and you see that it's a retracement, and it's very hard to tell the difference between a retracement and a reversal. Okay. But during a retracement, you want to see these. If you're in the market, you don't want to panic and sell and jump out of the market because you think the market's moving against you. If you had entered somewhere here, or here, or here, you want to be able to take advantage of this rally all the way up to here. And if you know that this is a healthy movement, you feel more comfortable about staying in the market. If every time you see price fall, you get panicky and sell out of the market, sure, you always have three choices. You can always buy somewhere down here and stay in the market until price falls, and whatever you're using to fall, sell at this point and get out of the market. But then when the market rallies back up and starts moving back up again, you want to buy again? Okay, well, first of all, the point spread will kill you. So you end up making small points because you never get to ride out the full market move. So you're buying, selling, you get eaten up by the spread and by when you can get back in that market. You're doing constant analysis. So remember, when you're trading with the trend and the trend is moving in your favor, you should ride out that trend, at least until wherever you've done your calculations before you enter the trade, where you set your target point. But even if you set your target point, say here, when you entered the trade down here, okay, you need to ride it. You need to believe that this trend is strong and doing well, because you also need to know where you set your stop loss, and also be able to say, okay, that isn't working out as well as I thought. Maybe I should take my profit and jump out of the market early. Okay. So you're not always going to get to your take profit target point, but if the market's moving in your favor, you should always get there and maximize your points, because remember, it's a game of odds. Okay. If you can get out of the market all the time with small risks or small loss by lowering your risk, that when you let your trade go with, to your target point, you make enough to cover your small losses and end up with a net profit. So let's go back to my PowerPoint. So whenever price reverses, most traders or investors are faced with a tough decision. They have three options. They can hold throughout the sell-off, which could be in large losses if the retracement turns out to be a larger trend loss. And a lot of times, because most of us can't afford big movements in price, we'll get stopped out. And that's a difficult situation. We'll sell we could sell and rebuy if the price recovers, which will definitely result in money wasted on commissions and spreads. And this may also result in missed opportunities if the price recovers sharply. 3, we could permanently sell, which could mean result in a missed opportunity if price recovers. But by properly identifying the movement as either a retracement or reversal, you can reduce costs, limit loss, and preserve gains. Now, traders have an expression for attempting to pick a market top or bottom, and we call this catching the falling knife, because a lot of traders would like to wait. You see a price moving up. Let's go back to my chart here. You see the price moving up. Okay. And then you see the price ease down. Okay. They want to catch that knife. They want to buy here at the lowest point possible or sell at the highest maximum possible. Well, that's never going to happen. I face it. It just doesn't. So we need to find a way to determine whether if we're sitting on the sidelines looking to enter the marketplace, we're looking for a buy opportunity along this line. And we saw the trend reverse itself here. We started seeing move up. To try to pick where this actual retracement will go to, what the bottom point will be, is virtually impossible. At some point here, you have to say, okay, I've got a retracement and it's going to rally back up. Now, support and resistance lines help you, or Fibonacci retracement levels help you, but you want to be able to enter the market at a given point. If you sit here and wait for that falling knife to hit the lowest point possible for you to enter, isn't going to happen. Same thing if you're using it to try to sell. So let's go back to my PowerPoint again. So remember, the hardest thing for all of us to do is to be able to sit comfortably when price is dipping or moving against us. Okay. But if we can remember that retracements are healthy, the market in general can become tired of moving in the same direction. It takes a lot of work and money to send an asset higher and higher and higher. When the price gets too high, buying pressure runs out when the money dries up. When demand dries up, price begins to fall and causes the chart to head south. This causes security to become more appealing to prospective buyers who believe that the stock or the asset has the potential of moving higher, but we're waiting for a better opportunity. As the price becomes more appealing at a lower point, the new buyers step in, creating demand, and once again, the price moves to another leg higher. But what I've just described is a retracement. Retracements are healthy functions of a solid trend, and they are the proper time to enter a position on the trending asset. Now you can see that after the retracement, an asset was unable to push to a higher high. So the asset's moved up. Okay. The asset, let me get my marker on here again for you. The asset was moving up, came back down, retraced, and started moving back up. But it wasn't able to make a higher high. It wasn't able to get past the point of this high. Most likely, what you're facing is now a reversal. Okay. So a lower high is not healthy. Okay. But it's not necessarily the end of a bullish trend. It's important that after setting a lower high, that the stock retrace again, never setting a lower low, and then pushes above the previous high to a higher high. The nail in the coffin of a bullish trend is to establish a lower low. Once a lower low is in place, your trend is over, and this is called a reversal. So in other words, price is moving up from this retracement, came down, retraced back up, hit this higher high, fell off of it, but it set a lower low. It hasn't set a lower low here, bounced off of there, but here it could not reach at a higher high, because in order to continue that trend, it's got to go above this high. So it's not able to reach that high, and then it falls back down here, and it breaks and sets a new lower low, because now this low is lower than the lows here. That's telling you this trend is over. So it's whenever it's unable to make that higher high, and whenever it makes a lower low. Okay. Now, what this is telling you is, because see, at this point, it could have retraced here, come back in here, and not made that lower low, not, in other words, not broken this low here, and then bounced up and continued that uptrend. Because there's no guarantee, it might have, for some reason, since the buyers hadn't jumped back in, there might be some economic events, might be lunchtime. So it could have then retraced back up and continued its merry way up its uptrend. It's once it breaks the low. See how this low was right on this closing? Let me just get these markers off here for you. See where this low was? This is the lowest close in this retracement. Moved back up, was unable to make the higher high, came back down here. So if it stayed here and reversed up, then we're still fine in the continuation of the uptrend. Once it closed lower than these previous lows here, that tells us that that trend is most likely dead and over. This would be also your sell point. If you were in the market taking advantage of the move up, and you were seeing this was a retracement, and you're waiting for it to continue climbing, you're fine. When you see this lower low being formed, that's now a reversal. And if you're in the market, that's your sell point. It's your jump out of the market point. So reversals are defined as a change in the overall trend of a price. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal also occurs. Now, this doesn't mean that it's going to reverse hard and fall straight down. It could go into a whole bunch of congestion, but it meant that uptrend is over. Now, you have to remember, markets can only move in three ways. They can move in uptrends, downtrends, or sideways trends, which are congestion. I read recently that 80% of the time, markets are moving in sideways trends. So it's very rare that you actually have a solid uptrend or a solid downtrend. They spend most of their time in congestion. So when we can see a well-deformed uptrend or downtrend, we have a lot of trading opportunities and potentials. So again, when you're faced with the difference between a retracement and a reversal, you only have three options. If you're in a position, you could hold on to your position, which could lead to losses if the retracement turns into a larger reversal. You could close your position and re-enter if the price starts moving with the overall trend, or you could permanently close and walk away from that asset. Now, because reversals can happen at any time, choosing the best option isn't always easy. So the following are the most popular tools used to do this. We can look at Fibonacci retracements, pivot point support and resistance levels, trend line support and resistance, chart patterns, which are chart patterns like pennants, flags, triangles, head and shoulders. Head and shoulders is a true reversal pattern, okay? Or other strategies. Now, Fibonacci retracements are an excellent tool for calculating the scope of a retracement. They are the most widely used in the foreign exchange market, but are also used in the stock market, and almost all CFD traders use them. To use them, simply use the Fibonacci retracement tool to draw lines above and below the top and the bottom from the latest move. So you want to use the last trend if the price is moving uptrend, you need to find the previous downtrend. Now, there's things like the 50% retracement level, which is from Dow theory, which means that a move up usually will retrace itself 50% down in the downtrend, or the opposite is always true. Now, Fibonacci retracements are excellent tools for calculating the scope of a retracement. They are the most widely used in the foreign exchange market, but are also used in the stock market. To use them, you simply apply the tool. In most cases, Fibonacci retracements will range at the 38.5 retracement level, 50%, which again is not a Fibonacci number, it is from Dow theory. And if the price removes below these levels, then a reversal may be forming. Pivot points. Pivot points are from calculations from a pivot point calculator and show support and resistance levels. And you can draw them on your chart and use those to support and see if price should bounce off of these pivot point reversals. And these should support a support level supports price, and a resistance level hold prices down. So most traders can put R1, R2, and R3, which is resistance level 1, 2, and 3, or you can think of floors above and below the price. We also have trend line supports, which you can draw a channel basically around your price movement and use these two trend lines as your determination as to whether price should stay within this channel. Because what it's doing is when you draw these on there, it forces price to make higher high, stay above the lower low because it's not coming down here, stay above. And so price should be easing along here. Whenever it breaks the support line, we know we have a slight problem, and price should be moving nicely if we have a defined uptrend in this pattern. Then we also have the head and shoulders chart patterns, which are true reversals. Head and shoulders is one of the most well-known chart patterns. And then we have triangles, ascending triangles, descending triangles, that will help us see whether we have a reversal or a continuation. And if it breaks out in the direction of the trend, it's a continuation. If it breaks out against a trend, it's a reversal when it forms into the triangle. Now, remember, technical analysis is the study of historic price performance in an effort to predict future price performance. Price is the only accurate measure of an investor sentiment, and it is the more intersection of supply and demand. Now, different strategies have different degrees of success depending on where the market is in the bigger time frame. So I'm going to share with you a little presentation on Fibonacci, and that you see how you can determine whether the market is making retracements or reversals. Because I can see even a retracement that meets all the criteria as shown in our presentation, or even over here in our example or our explanation on the right, may turn into a reversal with very little warning. The best way to protect yourself against such a reversal is to use stop losses. Now, here is how you can do it. We showed it to you in the presentation. You can estimate retracement levels using technical analysis and place your stop loss just below these levels. Alternatively, you can place a stop loss just below the long-term support trend line or a moving average. Ideally, you want to do is lower your risk of exiting during a retracement. So what you want to do is you don't want to place your stop loss so much so that as the asset retraces, you get stopped out. So you have to determine where you want to decide whether it's a retracement or where you want to panic that it might be a reversal. So you want to also be able to get out if it's a reversal in a timely manner. So as a trader, you need to be able to differentiate between retracements and reversals. Without this knowledge, you may risk things such as exiting too soon or missing opportunities, holding on to losing positions, or losing money and wasting money on commissions and spreads. By combining technical analysis with some basic identification methods, such as moving averages, support, and resistance pivot points, you can protect yourself from these risks and put your trading capital to better use. Now, I've tried to explain all this and give you screenshots and explanations in the handout that's called Retracements and Reversal Handout Guide. The Fibonacci's are all explained in the Fibonacci handout, and then everything so you understand technical analysis, trend lines, chart patterns. All of that is explained to you in the Introduction to Technical Analysis ebook that I handed you. But you have to combine these all together in formats. So if you were to do like I do, it always have a trend line on my charts, always have my support and resistance line on my charts. Okay. And that way I'm always prepared for retracement and then have a specific strategy. I trade from chart patterns. Okay. I trade from volume. I don't use all the complex other things. I might use MACD now and then. I don't use RSI. I don't use stochastics. I don't use all this other weird stuff out there. I always use candlesticks, but I've been trading with candlesticks for a long time. So I can look and see when a pattern develops. But whenever I see a bullish or bearish engulfing, a known, reliable candlestick pattern, or I see a flag on my charts, or I see a triangle developing and I see a breakout in the wrong way, I'm ready to get out of the market or ready to stay in the market. But you need to develop yourself some type of a trading strategy that deals directly with price action on your charts. And some basic identification methods. And you'll find that this will help improve your trading. Now, if you want, UBCFX has an extensive education section. And you can go over there tonight and watch their videos, use their education, sign up for their classes, and you'd be surprised in no time at all, you'll be turning price action into your best friend. So thank you very much for joining us tonight. Have a great night and best wishes in your trading. Good night now.